Investors have been changing their tune. There is a clear and obvious difference in what we had seen previously in the markets and today. Less stocks are making their new highs. Safety is more of a priority, and as a result, more stable stocks, fixed income, and cash seems to be taking the inflows. This is the flight to financial safety. You came here for the truth, so let me unveil that for you. Today's video was actually cut out of yesterday's video. That went on too long. It went on a tangent. I cropped this out and put it into this video. It's going to be short and sweet. Let's get into it right away. Equity fund flows have been very negative in the first half of 2019. Most people don't know this information. Most people are not going to get this when they look at the mainstream news. This is the 6-month rolling US fund flows, and that dark blue line, believe it or not, that's equities. I know you're seeing the stock market at record highs, but we know what's going on here. We have discussed this at detail so much all throughout the last few months. In fact, over the past couple years, I've been touching on it on and off, and it just shows you the reality of the situation. Things are not what they seem. This has been really documented and detailed, and I just wanted to show you it here because I think it's important to understand where the money is moving to and from. People are looking for more safe assets here at this time. We have seen the tensions. We have seen the countries that are going back and forth against each other, and it doesn't really look good, doesn't present itself with any sort of positivity when this type of activity is happening. Safe assets have performed very strongly, widening the gap to risky assets again. I just wanted to show you that really quick to give you that information, then we'll move on looking at this. Here we're looking at these 3 lines on this chart. The red line is the economic surprise index, just basically showing us that we are consistently underwhelming with the data. It is not up to par. Even though we see that stocks are going higher and higher and higher, it doesn't make any sense. Now, this gives us the idea that what we are seeing with bonds is very different than what we are seeing with stocks. The MSCI World Index is the dark green line, and you see that going higher all the time. Obviously, the only time that came down with any significance was during the fourth quarter of 2018, but it has resumed its higher and higher peaks, sitting right now at approximately the level it was at 18 months ago on the back of central bank easing and everything that we've discussed earlier. On the opposite end of the spectrum, what we see is that the yields for bonds are absolutely terrible right now. At the bottom, Bloomberg said this: "What looks more likely is that equities ultimately succumb to the macro logic that has fueled this year's bond rally. Everything must revert to the mean, and unfortunately for those who have taken on too much risk, too much leverage, they will be forced to accept reality." That's all for this video. If you found it informative, please hit that like button. By hitting the like button, you support me, so I do appreciate that very much. If you want the financial education you are not taught in school, these 2 books have everything you need. All the details are located in the link in the description. You're going to find out about the foundation, history, the asset classes, all the details. Click on that link. It'll bring you over there. You can flip through the pages for yourself. If you want the audiobook, that's available at themoneygps.com. Wait a minute, don't go anywhere. You need to watch this video. It's so important. Click on it and I will see you there.